Hello everyone. Today we are going to talk about three main things that are happening right now in the markets. First, a much better earnings season in Europe. Good to think a little bit about this. Second, the risk of Frexit, France leaving the European Union if the National Front wins the elections, and the implications of maybe yet another Greek crisis. And the third element is Germany's tremendous trade surplus, which just was announced the largest ever. Let's talk a little bit about these three elements. First, let's talk about the results. Results have been so far much better than what the market was expecting in Europe. 43% of the companies that have presented results, they have beat expectations. That's a very, very, very good thing. However, we have to be cautious because there's still plenty to go, and we have a tremendous amount of risk on one side in the banks, because there's still quite a lot of non-performing loans, about 200 billion euros in Europe. The second, in the energy companies. Energy companies have seen a little bit of tailwind coming from higher oil prices and higher gas prices, but this might be short-lived. Third, because industrial conglomerates are not seeing the level of improvement in cash flow that we expected, but we have to be at least acknowledging the fact that earnings are better than expected, could be the best year in 6 years after a very, very weak last 6 years of constant earnings downgrades. Let's talk about Europe and the risk of another credit crisis. It is quite small. Let's start from that perspective. Neither the euro exchange rate nor the risk premiums, the bond yields throughout Europe, are showing a relevant risk of another Greek crisis and a French exit. However, we have to analyze it. A French exit would mean that about 2 trillion euros of debt would be redenominated from euro to French francs, which inevitably would mean a credit event and definitely considered a default. That would be atrocious for the European Union and definitely for the French economy. Of course, there are many technical issues that make it very, very difficult, among them parliamentary approval, etc. However, we need to consider that we are seeing, on one side, French risk rising, second, Greek risk rising. After the bailout, they have consumed it all. Debt is back at very high levels, and Greece is not doing its homework. Increasing taxes is not working, and they're not making their economy more dynamic. So we need to pay attention to this risk, because the European Central Bank is going to start considering tapering at more or less half of in the second half of this year, and this all of it needs to be sort of in the mind of investors to consider the risk at least. Let's talk about the trade surplus of Germany. There are lots of talks about this massive trade surplus, more than 250 billion euros, a record high, and thinking that it's a very negative imbalance. And some people say that what they should do is to invest a lot more, spend a lot more, and that would boost growth in the European Union, and they are wrong. And the reason why they're wrong is very simple. If Germany tripled its investments and increased spending with the rest of the European Union, the impact on growth for the whole European Union would be less than 0.2–0.3%. More importantly, it would increase debt for Germany. It would increase overcapacity in the European Union, which is already an issue, as we have explained here. Third, it would increase the imbalances of the peripheral economies. So getting Germany to do the same mistakes that Spain, Italy or Portugal did between 2004 and 2011 is not going to sort out the problems of the European Union. The trade surplus of Germany is not a problem for the world, and definitely not a problem for the European Union. Thank you very much.